Okay. Coming right out of the box, you have 3 vector candles. The vector candles are an aggressive move. It's an engineering term, or a, I don't know, Zaim came up with this term because he was very technical and he needed something to make him feel better. So we came up with this. Market makers extend the initial low of the day in 3 pushes, right? This is the initial low of the day, correct? They extend that low in 1 burst, 2 bursts, the 3rd burst. The 3rd burst happens to hit our pre-measured 25 to 50 pip stop hunt zone. The stop hunts are made in 25 to 50 pip increments because they know where people trade and put their stops. This box is 25 to 50 pips. The shadow box comes in between 3 and 4 o'clock because there's variations on the theme. Just so happened they issue a hammer right in the middle of the shadow box. You got 3 swipes at the low, 25 to 50 pips stop hunt zone. They issue a hammer in the shadow, which is the session changeover. Understand, this candle was solid red at one time, right? You guys know this. Solid red pushing down. What does that do? Induces traders to go short. They then shift the zone away from the lower level shorts over here. But look what they did. They're dirty. They opened, they turned this red to push down one more time. You know what that did? They opened the spread around here too. When they get down here, they open the spread. Anybody that was already long in here has their stop. Where do textbooks tell you to put your stop? 3 to 5 pips below the candle I got in at, Steve. That is an absolute sucker's bet. You will lose your money every time. The stop loss goes below the low and above the high of the day. I will discuss it exactly where it goes. Market maker's job is to take your money and hit the stops, right? I told you this already. They absolutely ensure that they're going to get all the weak long holders spiked out right there. Anybody that's traded down to here by opening the spread at the low. The 2 gray boxes are, the shadow box is the gap time of the session. The gap time going into the open. The big gray boxes are the stop hunt zones. Okay? If you took the breakout here, okay, you remember the breakout systems? You bracket, break plus a close, you entered here. You saw very little profit on the spike, and then they pulled back and they jammed you up. If you didn't have the stomach to take the break here, you did not have a successful trade today. Or if you lifted your stop on the short, you were dragged backwards all freaking day. Anytime market makers hit a level 3 times and don't break it, the reversal is imminent. They will reverse. Look, hit, don't break it. Hit, don't break it. Hit, don't break it. There's your entry. If you entered here, you're okay. Why? You're okay because your stop goes above the high of the day. The high of the day will not be broken on these formations because there is some amount of money trapped above that price point. If they come back and break the level, it releases those traders' money back into their account. They're in the job of freezing the money in open float so they can take advantage of it and grab it up for themselves. Every chart that I show is 15 minutes unless I specify otherwise. Okay, so here's your opportunity for the trades. You had stop hunt low rise. Easily identified, Brinks trade in the shadow, 25 to 50 pips. 3 pushes out of the box. 2 pushes, consolidate, 1 more push to pick up the orders. You had a straight rise. If you grab the entry in here, anywhere in here after the hammer's issued in the shadow, you had a straight rise of profit. You were in profit in the first 15 minutes of the trade, depending on where you grabbed it. Maybe in the first 30 minutes of the trade. You then went negative, which used to scare you out of the business. When that went negative on you, 4, 5, 6, 7 pips, what'd you do? You're like, oh, crap. They're going to get me. I'm going the wrong way. Any trade that you ever take with this method remains valid until your perceived low of the day or high of the day is breached. Let me say that again. It's important. Any trade you take with my rules and my method remains in play or valid until the low of the day, where you should be entering long, the high of the day, where you should be entering short, is breached. What do I mean? Okay, let me draw. High of the day is formed right here. You took a short right off it. You got jacked up. You're excited. Okay, no problem. The better trade is just inside the shadow box short. That's all right, though. They hit it again. You're short right here. Your trade is negative. Your stop loss is above the range. You're out of the range. You're out of the grasp of the market maker. Think for a minute. He is not going to move a $4 trillion market to get Robert. Or Ted. I don't know if Ted's in here. He's not going to move the entire market back to get outside the range to pick up your measly one-lot contract. No offense to your lot size. Understand? If he moves a $4 trillion market back up, he releases $500 million in volume to pick up your order. He has two hands. In one hand, he has $500 million grabbed up. Right? He'll look at, right? He'll move to a level and analyze. He pulls away and he goes into consolidation off the high, right? If there is $700 million up there, he nets $200 million. He'll break the high. He lets go of the 500 and grabs the 7. He's a greedy bastard. If you understand that, he is not going to move the market unless it's financially advantageous for him to get your stop order. Some of you are writing that sometimes you feel like he goes after you deliberately. No. The reason why that you feel like that is because you've read all the same books that all the other guys, 90% of the traders, have read. And you put your stop where 90% of the traders put it. So what's going on here is you get in and you go, oh, my stop's right here. This looks good. It's a good trade today. Market maker comes back, spikes the high, and takes your stop out. And you're like, damn it, I swear to God, he's personal against me. Then it drops like you thought anyway, right? He's going after me personally. No. You've all had the access to the information that everyone else has had. It's all the same general knowledge. It's all bullshit. So when everyone gets stopped out at that price point, it's because the technicals that you saw that he deliberately showed you on the chart validated what you read in the book. So you took that trade based on that garbage, and he laughed to himself as he hit your stops, all 100 million of you. Understand? That's why when you took those trades and they didn't validate and you felt like he was personally attacking your stop loss, he was not. He is not going to move a market to a price point to get Mac or to get Michael. He's not going to do that. But if it's financially advantageous for him, he'll make the second pass or the third pass. This costs money to move the market. I heard that it takes 10,000 lots to move the market. A pip. I didn't hear it. I was taught that. Think about that a minute. If you have to move the market all the way back up here, it costs money. If it costs money, he's not going to do it unless he can make some in the process. All right, I want you to notice some crazy stuff built into this structure towards the high, okay? I want you to see a 1, 2, 3 back to the high in there. Do you see that? 1, 2, 3 back to the high. Why? To induce you to chase it long. I want you to notice they rise here, and each subsequent pass fails to take out the previous high because there's trap volume here, There's trap volume here. There's trap volume here. There's stop orders all aggregated in here and in here. His job is to hit the stops, don't release the volume. Hit the stops, don't release the volume. Sorry about your luck, just kidding, and drop price 100 pips off the high to end the day back in consolidation. Boom, right here. End the day back in consolidation. And just if you weren't sure, he has to end the day on a hammer to trap anybody that was chasing it short last minute, snatch that away from them, and end the day trapped, carry you into the next day. Do you see what I'm drawing, what I've been illustrating for you? It's in there. Releasing the volume means that if there's a certain amount of traders that they already trapped, by going back to that level, it allows people to click their mouse and get out. Think about yourself in your own trading. How many times have you been jammed up in something, instead if it goes back to +1, I'm getting out. If it goes back to -5, I'm getting out. When you come back near the second pass, you will be minus some number plus the spread. -7, -5, +2, +1. I don't know. It depends on where you got in. So what he's doing, if he goes back and breaks that level, he's allowing those traders that were jammed up a chance to close their account out with a small scratch or a small, loss or gain in the trade. His job is to not allow that behavior, so he fails to take out the high. Okay? All right, I hope you guys are good. Let's see where we're at. Next slide. Okay, it's 8:30. We'll do this slide and we'll break for 30 minutes is a good dinner time. We'll try 30 minutes tonight. If it's too long, we'll shorten. If it's too short, we'll go an extra 5, whatever. I'm going to grab a little something to eat, and I'm going to get some more Diet Coke. If I'm not jacked up enough for you guys, I'm sorry. Some of you made comments. I feel fine, man. So if you think I'm too calm tonight, I'll be more excited tomorrow. Okay, look. Very important to understand. Market makers have limitations. They are limited what they can physically do to the market. If you think about this for a minute, they're controlling the value of imports and exports. You buy Toyotas and you switch your dollars to yens. They're controlling that. They cannot just wake up one day and drop in 1 million pips and devalue the dollar or devalue the yen. They cannot do that. They have restrictions placed on them by the IMF and the World Bank to try to keep this world afloat. That is why the average daily range tool, told you I'd get back to it, Mac, is a useful tool and can only move most pairs about 200 pips a day to 600 pips a week. And if you notice something on some of these charts, they will open the week at a price point, go berserk, and come all the way back and close the week around the same number. They do not, contrary to popular belief, have unlimited equity. They got to get their money back. That's where the retrace against the trend comes in. They lend it out, they lend it out, they lend it out. They got to get it back. They are limited by weekly net change allowances. They have a couple of times during the month where they can run rampant, but they got to get it back under control. Think, use your head. If they could do that, they would destroy the world economy, and things are bad enough without doing this to people. They have some limitations. Understanding the limitations gives you an edge. Understanding that they don't have unlimited movable pips gives you an edge. Okay? All right, let's take... It's 8:31. Let's go to 9 o'clock. And we'll pick it back up from there. Hope you guys are doing okay. We're going to go to about 10:30 tonight, I think. And then we'll be good. All right, let me find my little clock somewhere. I'll pop it up there. Go ahead and grab a break. I ain't going to say anything now that it's break time. I won't do that to anybody. All right, let's see. Clear. 7 minutes ain't going to work. I saw a couple questions. Craig had 2 good questions. Let me cover those real quick because they are time appropriate. They're in the right segment. Steve, you said there's three important things: the patterns, the timings, and what? The answer is the levels. Okay, most important element in the system, the pattern, identifying the patterns from the market maker behavior. The timings of those patterns, and counting the levels. The levels are not going to come to you overnight. They're difficult. There's people that have been around me for a year still struggling with that. It is not an absolute necessity to be successful with this method. But understanding the levels will let you know when the reversal's coming, when to exit your swing trades, and so forth. Okay, weekly net change allowance was another question that came up. Let's say they open at a price point. They're given, just to make it easy, 1,000 pip movement, weekly net change. So from the open price point, in the 3 to 4 day swing range, they cannot exceed 1,000 pips on the close on Friday. So if they rise price 1,000 pips or 1,100 pips,